G'day. Welcome to Lunch Money. We are the online and social media home for special situations, workouts and capital raising professionals. My name is Nick Samios. I am the fund manager and director here at Hermes Capital, and I'm your Lunch Money host, and a very special warm welcome to you. Well, what a week it has been. It's been a week where obviously we've had the US election, and we're not quite sure what that means for Australia or for the world at this point of time. Does it mean more money printing? Does it mean more trade wars with China? Who knows? We've also had, on the home front, we had the Melbourne Cup, and of course Melbourne Cup Day means the day when the RBA makes its interest rate announcement, and interest rates were once again lowered to record low levels. I think the official rate now is 0.1%, and that particular day, it was 10 years in Australia since the RBA had increased interest rates. Think about that. 10 years since interest rates were increased in this country. You have to wonder what all of this means, because we've got interest rates going down, but we've got high levels of unemployment. We don't really know what the unemployment rate is, because we've got JobKeeper, we've got these insolvency moratoriums, obviously, that come off, insolvent trading moratoriums that come off at the end of the year. And what does it all mean? What's going to happen next year? Well, you could seek solace by reading what I call the big name mainstream economists, but I find that the big name mainstream economists, firstly, I feel as though they've all been drinking from the same Kool-Aid, and I find them ideological as well. And in any case, even when they not being ideological, they tend for me to be vague and non-committal. They like to hedge their bets, as you know. I'm sure many of you have been to economist breakfasts, and you're not quite sure what to think when you come out of it. So today, I have a very special guest, Martin North from Digital Finance Analytics, who I'll introduce in just a moment, who it's a great privilege of us actually to have him on a guest here at Lunch Money, and hopefully he will help to tell us what to really expect next year. Before I get to that, I'd just like to quickly remind you to subscribe to this humble podcast, and to give us a like. I mean, why don't you like this particular episode? That'd be great, whether it's on Facebook, YouTube, LinkedIn, or for that matter, Apple Podcasts. How about that? So without further ado, I would like to introduce our special guest, Martin North from Digital Finance Analytics. G'day, Martin.
G'day, good to see you.
Fantastic. I'm very, very privileged to have you as a guest, Martin. I am one of your fanboys, and I'm not embarrassed to say that.
Well, thanks.
I think I said to you the other day when we were talking, I said, I think that, if someone came from a foreign country or from out of space and landed and said, look at what's going on and just tell us what's actually going on. Look at the numbers, tell us what's going on. Forget about the ideology, forget about the politics. Can you just please tell me what's actually happening? And that, to me, seems to be what you do.
Yes, well, being independent means I can actually just take the data as it comes, think about it, and try and really peel back the layers of the onion to really say what is going on here. And my background as a philosopher means that I also tend to go a bit further into things than many people. There's a lot of ideology out there. There's a lot of mainstream media spin. There's a lot of course stuff coming from the government, particularly now. But it's important to stand back and trying to get a more objective and independent view, I think. And that's what we try to do at DFA.
I think it's wonderful that you call yourself a philosopher, and this is not the venue. Maybe port and cheese sometime. I'd love to hear you sort of wax more philosophically outside of maybe the immediate realm of economics. But can you just tell us a little bit about your background?
Sure. Yeah. Well, philosophy is interesting because it basically asks the question behind the question, right? Why is it that things are the way they are? And there's a thing called the frame of reference, which basically says what's the context for the assumptions that people make. And look, my background is that I actually spent some time at university in the UK, went to Oxford, trained as a philosopher, then went into financial services, worked in London for a good number of years with some of the big banks there, came out to Australia mid-95, worked for some of the banks here, then went into consulting, places like Booz Allen, Anderson, and then came to Fujitsu and spent quite a long time there running a consulting business inside a big consulting and IT company. But about 10 years ago, came out and started creating digital finance analytics. The YouTube channels walk the world, of course, and that's really what I've been. So I've been running my own show for 10 years plus, been quite successful, I think, in terms of creating brand awareness, showing how data is important. We survey households a lot of the time, and that really goes right back to when I was in the UK in 85 to 95. That was in where I started surveying households, trying to get to understand more about what's really driving them. And we also survey SMEs. Again, did that way back then as well. So I tend to come from the consumer and business end rather than the corporate end out, and then try and understand what's really going on, what's driving people to do what they do, what's the economic context for those households and businesses, and therefore what does that mean in terms of businesses and servicing. So that's how I've got to where I've got to. I'm very proud of being, an independent observer, and so I don't toe party lines. I basically try to go where the data takes us.
Yeah, that's interesting. I mean, look, it sounds like in your background when you're talking about Booz Allen and some of that consulting that you've done. So obviously, you've been in the business of providing data that people would make big financial decisions. Booz Allen aren't consulting to people who are making small decisions. So obviously, that's interesting. So you've been where the rubber hits the road in the past. I should say that anything we say today is not financial advice. And just for the sake of completion, we'll put up our financial advice disclaimer. So if you need financial advice, go elsewhere where somebody knows your personal situation. I would like to show you, Martin, just a couple of, I just want to show you something in our world, or in my world, when we're talking about special situations, and normally special situations entails elements of distress, and that's so we're funding special situations. And I said to you before, because of JobKeeper and because of insolvency moratoriums, things have been very quiet. And in fact, I'll show you a graph here of the voluntary administrations year on year, and you can see there the blue line is voluntary administrations last year, and then the red line is voluntary administrations this year. And it sort of seems counterintuitive. When this COVID thing first hit, all the insolvency people thought they were going to be run off their feet. Certainly we thought that there'd be a huge demand for our capital. But of course, all of the government intervention has happened. They've kept the economy afloat, and it does make it very hard to see into the future. So how do we see into the future? What is going to happen next year?
Well, I guess there's a few important points to make. The first is, of course, if you think about the amount of stimulus that's come in, it's 100 billion plus from the government, and that's including JobKeeper, JobSeeker, superannuation withdrawals, which, by the way, made probably the biggest contribution to people's finances. And so, as a result of that, we've seen household savings ratios rise quite significantly. We've seen, of course, JobKeeper keeping people employed, so the real unemployment rate is way higher than the official rate. I reckon that about 1 in 5 households are either unemployed or underemployed. That's 20% of the workforce. That's very, very high. And I don't think that's going to come down very soon. So one of my observations is expect unemployment to go higher rather than lower from this point forward. The
Right.
second is, of course, JobKeeper has protected a number of businesses. And I think the most significant move was when they basically put the whole idea of a business could fail on ice until the end of the year, frankly. And of course, you've also got the principal and interest repayment holidays for mortgage holders and other borrowers as well. So that's really put the whole economy into a really weird situation where people can continue to trade insolvent, where
Yeah.
people can effectively get away without making any loan repayments. What I worry about is the implications of this from two fronts. If you are effectively trading with a business that's actually trading insolvently, but you don't know about it, you're actually spreading the risks more broadly through the economy. My worry is from my surveys, I survey small businesses, I think about 25% of businesses are basically saying to me they don't think they're going to survive over the next year or so. And that's because, of course, cash flow is a major critical issue. So people are trading insolvent. That's a big deal, right? So I think at the end of the year, when the legislation is effectively reversed, unless they extend it, we're suddenly going to see a rush of people to the exit.
Well, let me ask you two questions on things that you've just, if I can sort of ask couples of what you said. Now, the first thing you said, well, you said many things. One of the things you said was that there's been $100 billion worth of stimulus in JobKeeper and all the rest of it. And I'm going to ask a question that's not going to make me look very bright, but that's okay. Just So the 100 billion that is in stimulus. Now, the other day, the RBA announced that they would be buying $100 billion worth of bonds, if I'm correct. Again, this might sound like a silly question. Is $100 billion a lot of money these days?
Well, it's pretty much. So, if you go back to the June quarter, that was more than 20% of GDP that was actually being thrown in to the system, right, from government. So that is a big number. And by the way, that stimulus dropped by 75% since the last month or so, and will drop again by 75%. So essentially, once we get into next year, all that stimulus has gone.
Yeah.
Right. And
Yeah.
interestingly, if you look at the budget, the amount of stimulus that the budget is talking about putting in is way lower than that. So people should not think that we've got all this liquidity, that all the Reserve Bank stuff is going to create massive amounts of additional momentum in the economy. We're actually fighting a receding tide of liquidity. Right?
Well, I do wonder.
Now,
well, firstly, let me just ask you another thing. Well,
yeah.
one of the points you also made was this insolvent trading issue, right? And you said people are telling you, I think you said 25% or some large number are telling you they don't think they're going to be in business when the music stops, whenever that might be. The thing is, they're telling you that, right? But they're not telling, I bet you they're not telling their suppliers that, right? So this is where you have insolvent trading as a contagion. Because you that one of those 25% of businesses, they are ordering stuff that their suppliers are providing in good faith. Now, of course, when the 25% go under, well, then the supplier, unless the suppliers have got robust balance sheets, they're going to find the pressure as well.
Yeah, and the point there is it's not equally spread across the economy, right? So a lot of it's in retail. A lot of it's in the education sector. A lot of it's actually in some of the construction sector players too. So yeah, I'm expecting a really big shock as that stimulus is withdrawn, and as those rules change at the end of the year. And of course, the banks are now starting to actively approach people who are no longer paying interest and principal repayments on their mortgages. And remember, there's a fair share of small business owners who actually have a residential mortgage, which secures the business, right? So that's another factor. So that's another factor. So as well as the supplier risk, which I think is being massively stated as a significant risk ahead, the second is that this residential pressure on businesses who've got a secured loan against a residential property and are now in difficulty means that they may need to actually take quite drastic action. And the interesting question is, if you are in difficulty, and again, the regulations have been relaxed to allow people to sort of quote trade through this. The question is that sensible, or are we actually building up a whole series of issues over the next few months and into next year, bearing in mind that unemployment is going to go higher, bearing in mind that the virus, of course, although it's sort of benign here at the moment, around the world it's still raging. So the international borders are going to stay shut probably for a good number of months, which means we're not going to get a whole load of international tourists coming into Australia, and many people in the tourist and related sectors are really struggling because of it. And, they'll fight for sort of interstate movements. It's not enough to be able to support it. Education, of course, is a big sector, and that's very much under pressure. So there are so many factors that I think people are not adequately taking into account. Now, the truth is that the government has thrown massive amounts of liquidity into supporting the construction sector, all those stimulus, home builder and those sorts of things, and the 95% loans for first-time buyers. So they're banking very heavily on the construction sector, but it's a very narrow, myopic strategy. What about the rest of the businesses? That's the question I've got.
Well, there is this talk, of course, of trying to kickstart the manufacturing sector, and we did a special on that a few weeks ago. So, I guess, and the mining sector seems to be going okay. I mean, I was talking to a finance broker yesterday in Perth. Before COVID came along, my life was I used to travel to Perth once or twice a month. Melbourne. I was traveling all the time, so I used to frequent Perth. Haven't been there since March, February. But he told me that basically it's been business as usual for the last 6 months in WA. I mean, they're apart from the fact there's no one going there, but the mining sector is doing just fine, particularly mining services, which is more the space that we tend to play in. You know, all those guys
Right.
with yellow diggers and what have you, they're going fine.
Okay, but the question is, how many thousands of people does mining employ across Australia?
Yeah, not a lot.
Right. And
Relatively.
yeah, it's a big economic driver in terms of exports. Although, of course, if China is turning off coal, which it looks as though they might well be now,
Yeah.
and if Brazil is powering up their iron ore exports from Vale, we could suddenly find ourselves in a rather different situation. My point is, mining is fine, but it's not going to support the broader economy, right?
Mm.
Construction is 13% of the economic activity, right? And it employs more than 1 million people. That's one of the reasons why the government's throwing heavy money in that direction. But that itself is not going to support the economy. My problem is that the businesses that need support, those small and medium enterprises, the ones that actually become bigger businesses with a bit of help, aren't getting the help. Right. And if you talk to a lot of those businesses I do, many of them are not getting sufficient support in terms of loans from the banks. The banks will always want security, and
Yeah.
that's a problem.
Yeah.
The banks would much prefer to lend more mortgages because that's more effective from their cost of capital perspective, and the risks are essentially lower. It's messed the playing field.
And now, if you go around town and talk to all of the insolvency people, whether you talk to the big firms or the small firms, they're not getting any work, and there's no triggers. So whilst those small businesses that you're talking about, they're not getting any support. On one hand, they're not getting any support, but on the other hand, no one's pushing them either. So the loan restructuring areas of the banks are not pushing anybody, and this isn't necessarily the area that we're talking about. The CBA home loans, they're not going to force home loan sales until September 21. I'm not exactly sure what that is, but whether or not it's home loans, I'm talking more in the commercial space. If you've got $2 or $3 million owing to Westpac or one of the major banks, they're not kicking you out. They're on a go slow. They don't want the negative press for a start. You know, the Banking Royal Commission is still fresh in everybody's minds. They don't want to cause contagion. They don't want to cause a run on assets. The ATO is normally a pressure point. Well, the ATO isn't winding anybody up. Creditors, the statutory demand process, whereas you used to be able to issue a statutory demand and have someone wound up in more or less 21 days, that's been extended to 6 months, and it's virtually pointless. And what's the point of pointing a gun at someone and saying, if you don't do what I tell you, I'll shoot you in 6 months? So there's no pressure on the other hand either. So you might say there's no support, but there's no pressure. And that's why we're in zombie territory.
Yeah, and that's the point, right? The key question you've got to ask yourself is, where is growth going to come from, right?
Yeah.
That's the key question. And, the Reserve Bank's estimate of growth over the next couple of years is a lot lower than it was previously, right?
Yeah.
I don't see
data or.
Well, we can do. I mean, it depends on how detailed you want to get, because there's obviously quite a lot of information from the Reserve Bank. But let me make the general point first, right? So essentially, there is some growth, but it's not very strong growth. And if you look at it carefully, the growth engine in Australia, which was migration, right, has been turned off because of the border closures. Education is not there, so we're not seeing that engine firing. Right. So, you go across tourism, education, migration, all of those growth levers. And look, the truth is, our economy has been firing more on greater numbers of people. So if you measure growth, it's gone up. But if you measure growth per capita, it's not been going up anything like as much. So we've been effectively supporting the Australian economy simply by getting more people to come in. Now, the other point to make is that the disposable income that households has is a little bit up at the moment because many people have been saving, and of course they haven't made those mortgage and principal interest repayments on mortgages, that sort of thing. But the fact is that there are many households who are now less able to spend. 3 million savers, for example, who are now seeing the interest rates on their term deposits drop to close to zero. They have no income coming from that, or the dividends from the banks way down from where they were previously. So what we are seeing is quite a lot of households have less disposable income. So that's another reason why growth will be lower. And I guess what I'm calling out is that I think this whole story of how this economy is going to go over the next 2 to 3 years is being spun by the government, but I don't think it's very credible. And as you start thinking about, those small businesses who may fail, the fact that the international borders will stay shut for quite some time, the fact that the money that's being thrown into the economy and even the Reserve Bank's direct liquidity is, encouraging more people to borrow, to borrow, to borrow. But what happens if those people are unwilling or unable to borrow?
Mm.
And one of
That's
the
what
pieces of it.
yeah. There's too much uncertainty. When you say people, I know you're talking about consumers and small businesses. The trouble with small business, and I'm not talking about tuck shops. I'm talking about businesses are turning over $5 to $20 million, say. They don't know what's around the corner, and so they're reluctant to make the investments, to borrow. So that's the trouble. There's a reluctance to invest, which means there's a reluctance on the flip side of that to borrow the money required to make the investment, because no one's really sure what's going to happen.
Yeah, absolutely. Let me just show you this slide that came out from the Council of Financial Regulators in October. It's a bit of a busy slide, so I won't hold it up for long. But I just wanted to show you that this is what they said. Look, basically what they said was a key focus was the importance of the continued flow of credit to the economy, particularly to small and medium enterprises. Members agreed that demand for credit among SMEs has been subdued, and improved confidence in the health and economic outlook will be critical to addressing this. So what they're basically saying is credit demand is the issue, not supply. And if I just show you with this other chart here, this is actually the most recent credit aggregate data. And this shows you that the broad money, so the amount of money flowing around in circulation has gone up by 12% over the last year. But total credit growth is only 2%. That's as low as it's ever been, right? So we actually have a fundamental problem insofar that there is plenty of money flowing from the Reserve Bank and from the 100 billion that you mentioned, et cetera, all that sort of QE, but it's not actually going into productive use, right?
Yeah.
So
Yeah.
the economy won't function properly unless people are willing and able and confident enough to borrow. And the fact is they're not. And that's one of the reasons why this whole argument, there's a big argument out there about, is the future going to be inflationary or deflationary, right? So the argument is all of this money printing, all of this QE will lift asset values, and that is going to create massive inflation. This chart that I showed you earlier on, and the fact that the Council of Financial Regulators is saying credit demand is the problem. If there is insufficient demand for credit, you can offer as much credit as you like at low rates as you like, but it's not going to have any difference. And that's my problem with the Reserve Bank strategy. Taking rates down, may or may not be a good strategy, but it's not going to actually encourage people to borrow unless they've got the confidence to borrow. And then the question is, what gives them the confidence to borrow? It's not necessarily low interest rates, because low interest rates are a sign of a poor economy, a poorly managed economy, rather than anything else.
All right. Well, so I get absolutely howled down on Twitter as if I'm some sort of a Neanderthal whenever I try and advocate good old-fashioned Austrian, supply side economics. Just deregulate the hell out of everything and cut taxes. And everyone goes, "Oh, look, you don't understand MNT, and all this sort of stuff." I mean, I know we could talk about it for hours, but what's your take on all of that? Like, why am I a Neanderthal for thinking that deregulation and tax cutting is such a terrible idea, given what you've just said about zero interest rates aren't going to make a jot of difference? And why is MNT so wonderful?
Okay, well, there's 2 points to make. The first is when interest rates are very low, taking rates even lower has only a marginal improvement, right? So if rates were 10%, you move them to 5%. That's a huge positive impact. But moving from a very small to a very, very small number has hardly any impact. So we've got to the point now where we've reached what's called zero bounds. The main reason interest rates are so low is to try and drive the exchange rate lower. Now, the Reserve Bank wants the exchange rate lower because they're hoping that will, one, import inflation and two, make us more competitive. So therefore, that will help with growth, right? But the truth is that the exchange rate today is 70 something, right? So that hasn't worked. So basically, that strategy and that the ability of the Reserve Bank to move the exchange rate and indeed influence anything is pretty bad. Their forecasting is worse than mine, frankly. The second point is rates are really, really low, that means that funding is really, really cheap. And the argument from the MMT is, that means that you can now afford to borrow a lot. Doesn't really cost you anything at all, because basically it's two sides of the same balance sheet just going higher. There's a transfer, but that's all it is. And it's what you do with it. Now, the question is that's the key point. It's what do you do with the money? Now, my argument is that MMT has a place if you can invest it in productive development of the economy, and which means building infrastructure, which means building new businesses and greater businesses. I mean, after the Second World War, we got ourselves out of the hole simply by significant expansion and development, right?
Yeah.
Now, but the money that's currently being created and thrown through the economy is not going to those productive sources. So there is a big question as to whether MMT can work if the money is not going to the right places. And my argument is, looking at the supply of credit, it's lower than it's ever been. It's not hitting the right areas. So my view is that is not necessarily going to work. And
everyone says, the MMT people say, well, there's been no consequences, that we haven't had inflation. And so the MMT's underlying thing that you can print money with impunity. As a matter of fact, you've got a moral obligation to print money. And don't worry, we'll dampen the inflationary effects with taxation. Now, my answer to that is, well, yes, I can drive a car off a cliff, and for some of the time there, I'm having a great time. And I think that's where we are now. We've driven the car off the cliff. The fact that we haven't hit the bottom and suffered the consequences doesn't mean that driving a car off a cliff is such a crash-out idea. And that's how I view it.
Yeah, well, I tend to argue that it's opportunistic for the MMT argument. There is definitely a place for government investment target, and personally, I think there should be a government investment bank that's really set there specifically to invest in infrastructure for the long term, because a lot of the money that's being thrown out there at the moment is not going. And look, just think about this: what proportion of the total government spend is on things like unemployment and health benefits? It's very, very high. It's more than 50%, right? So, and in fact, we have a very bad set of parameters around the economy at the moment. So what we should be doing is thinking about trying to change it different. Now, my own view is this, that we need to get rid of some of the regulation, get rid of some of the red tape, get rid of this whole idea of trying to control the economy. I think central banks should step back rather than step forward. And basically, capital should be allowed to go to those areas where it can create the most benefit. That there will be and should be failures, because what you're then doing is allowing capital to reallocate, which is the whole idea of the way that economies should work. But frankly, a decade ago, from the global financial crisis and since, nobody wants to actually allow anything to fail. They want to keep trying to keep all the balls in the air. And I would argue that the central banks have basically driven a whole series of bad outcomes, because what they're doing is creating a bigger problem with more and more of this funny money flowing around the place. It's not actually getting to the right answer. And I would argue we're backing ourselves into this cul-de-sac where it's going to be very, very difficult to get out. Look at Japan, look at the Eurozone. They've gone into negative interest rate territory, and they're still not doing the right thing. And the problem I've got is the argument of doing more of the same, only bigger, which is what the Fed is doing, expecting a different outcome, is, I think, naive.
Yeah, well, I had an article, Warren Hogan wrote a great article the other day. He was arguing that the consequences of free money, I can't remember his exact words, but the consequences of free money were financial instability, because you have asset price distortion, pushing activity outside the core regulated, so money lending goes outside the banking system where it's not controlled. And then, of course, economic efficiency in terms of this zombie company scenario, where companies that may or may not, maybe shouldn't be in business, are competing with companies that should be in business. I mean, I've got a saying, I've said it a few times on this show, that everybody knows, having watched a George Romero movie, that zombies love to live off the flesh of the living. That's what's happening there.
Well, the key point about zombies, that's really important, right? If you look at a lot of that liquidity that's been pumped around the system, right? A lot of firms have been buying back their own shares, artificially inflating their share price, but they're not actually productive companies themselves, right? House prices are going higher, the banks are getting bigger. It's not productive. That's the problem. We have to find an alternative strategy, in my view, so that we actually become more productive.
Now, tell me, just in terms of where the rubber hits the road next year, I guess I've got three questions. Let me throw them at you, and then sort of answer them at your leisure. One thing is, do you think that we are going to see a lot of insolvencies come the new year? I mean, is that what you're thinking? What are the sectors that you think? We've already said that mining doesn't really employ enough people, even though it's doing well. I mean, what sectors do you think are the sectors to be in next year? I guess they're my two questions. Yeah.
Look, the fact is, yeah, I expect higher levels of insolvencies next year. The SME sector is going to be where it's going to be focused. What's interesting is I can see particular geographic areas where we're going to have issues, and I'll just show you this map. So this is a map around Brisbane, in fact, and the way to read it, we measure what's called financial stress. And so there are particular areas around Moreton Bay and down towards the Gold Coast. The more red and orange, the worse it is over in Toowoomba. Now, these are from our surveys, and this is showing us the hotspots where we expect the default rates and delinquencies to be higher. And we measure it from an SME perspective, from a investment property perspective, and from an owner-occupier perspective, right? So expect to see in some areas considerable numbers of failures. I'll give you an example on the Gold Coast. In the Gold Coast, there are a lot of people who are very reliant on the tourist sector. There are also a number of people who are completely reliant on Airbnb as a source of income for their investment properties, and they don't have enough, not enough people coming through at the moment. Those two examples. So that's to do with the international borders being shut and the fact that tourism is way off. Another example, another sector, is in the small business end of construction. So there are a lot of independent tradies. Now, there's quite a lot of new construction happening thanks to Home Builder, but it's not necessarily uniform across the whole country. And we're seeing quite a few tradies having to move into other areas to be able to be busy. But also, a lot of them were, perhaps using two or three people in their team. They're now down to one, and they're less hours. So that's going to be another issue. Another area is retail, and I think retail is probably going to be the real bellwether. There are so many closures of small retail outlets, and so many of those are actually now. If you go down some of the, for example, I live near Wollongong. If you go down Wollongong, there is row after row after row of closed retail establishments down a number of the streets. And I'm seeing it everywhere I go, and that's another area that I think is going to be very concerning. And then the final one is the hospitality and restaurants and cafes. A lot of those have really struggled. I mean, hopefully they're beginning to see some, but a lot of them are already well underwater. So I think it's going to be the small end of town rather than the big end of town. And I'd argue that JobKeeper really was top end of town keeper and bank keeper rather than real small businesses. So I would expect to see a lot of smaller businesses really fade away, and that's what my surveys are showing at the moment.
And are you projecting this early next year? Is it later in the year? Are we talking March quarter, June quarter?
I think it's going to take probably 6 to 12 months to work through. So if you look at the global financial crisis in both Europe and in the US, the crisis hit, and then it sort of echoed down for 18 months to 2 years before it really hit the bottom. In fact, the bottom of house price falls and the height of delinquencies and failures was actually in year 2 and year 3. So I'm expecting that to be slightly quicker this time because the bounce back perhaps was a bit quicker, although it's still partial. We're still performing well below where we were. The unemployment rate's still a lot higher. And if you look at the last payroll numbers, they were way down compared with what people thought they were going to be even this last time around. Job average up a little. So my assumption is there will be a little bit of pullback, but I reckon it's going to be another year or so before we really see the full impact. So I keep saying to people, we are in the foothills of the financial crisis. We are not actually in the exit lane of the financial crisis, right, that we've just gone through. We're in the early stages of it, and it's going to get worse. Even the Reserve Bank's saying it's going to be 8 point something percent unemployment end of the year, and 6.5% 2 years later if we're lucky.
But last week the deputy chair came out and said that the recession was over.
Yeah, well, I think that was a bit of an overreach, frankly. And it's mathematically true, right? Because if it drops 10%, that's a fall. If
Yeah.
it moves up 0.5%, it's a rise, right?
Yeah.
And so you could say, yeah, well, I've had two quarters of a fall and then 1/4 of a rise. But if the rise is only, a very small amount, the economy is still way smaller than it was a year ago,
Yeah.
right? And that's the problem. I reckon it's going to be 3 to 5 years before the economy will be back to where it was, and we're going to have in that time lower migration, so probably less population. The budget forecast net negative migration for the next 2 years. That's pretty amazing.
It is amazing. Look, I've got one of my sons was doing a 5-year university degree, and he was thinking of, as a double degree, and he was thinking of sort of shortening it to one before the COVID hit. And when COVID hit, I said, listen, you may as well sit it out and complete the full thing. Is there any silver lining in the, I know you said 3 to 5 years out. Is there any silver lining in the next 12 months?
Well, I think there are some opportunities. So I would say that there is a great opportunity for people who are able to think about perhaps creating a business or, starting something new. Perhaps they've had to switch jobs or, so there is an opportunity. The second is, I think property is interesting to watch. I still expect property prices to fall further before they come up. There will be perhaps opportunities there later. The third observation I'll make is that if only the government had a better attitude and a better investment path, and was investing in the things that were really there and sustainable for the long term, the infrastructure programs and those sorts of things. And I do think we should encourage more manufacturing, not just those 5 or 6 areas, but more broadly, smaller firms who actually could grow and could become growth engines. I would be looking for a whole series of programs to support those particular areas. We need a more productive manufacturing sector. Our manufacturing in Australia has gone through the floor in terms of the proportion of the total economy. And my own view is that should be definitely reversed. The final point I'd make is, actually, we have an opportunity now to decouple ourselves slightly from China. We have become so China dependent and so China reliant in terms of our economy that we've been myopic. There are many businesses who are completely exposed now to what China does. So this should give us an opportunity to think about alternative markets and alternative strategies to be able to actually go and do those things. And I'd also add postscript and digital, of course, all the stuff we're using now. Digital now has really come of age, which shows that you can do things that you couldn't have done previously, and you can reach markets and you can reach people that you couldn't have done previously. So I think there are opportunities. There are blue sky things that you can see, but I would say just don't take the mainstream story too seriously. There are a lot of critical issues we have to navigate through, and unfortunately I feel that the official story is not giving us the right basis on which to make decisions.
Well, there's a very easy way of avoiding all of that mainstream misinformation, and that is to do what I do when I get home. Is I turn on my smart TV, and I have subscribed to your YouTube channel, Walk the World DFA Analyst, and you're putting out a lot of content. You had a very busy this week. I think you had 2 shows in one day. Was it yesterday or the day before?
I know.
And
we're a bit mad.
I would encourage our viewers and listeners to seek you out on YouTube, on Walk the World. Is it Walk the World DFA Analyst?
Yeah. So basically, the YouTube channel is actually called Walk the World.
Yep.
But you'll find me there. Or if you do digital finance analytics, there's a search on YouTube. I've also got a blog at digitalfinanceanalytics.com, and I put all my posts there. I'm also on Twitter as well as DFA Analyst. So that's where you can find me. And I run live shows every Tuesday at 8 p.m. where we cover all sorts of things. Next week, I've got a mortgage broker talking about property dogs and property stars. What's the difference between the two? So we always pick a thing to talk about, and I post daily shows on finance, economics, policy matters, and all those things. So yeah, there's always at least one what should I say, independent, hopefully objective, and maybe a slightly alternative voice that you can always get from DFA. And I'm glad that you watch some of my shows.
But your guests are also very interesting as well. I love those regulars that you get on Mondays and Fridays. They're fantastic. Thank you very much, Martin North, for joining. It's been a real privilege. Thank you so much for coming along.
Well, I've enjoyed speaking with you and meeting some of your viewers too. Have a great day, and we'll catch up again sometime down the track.
Thank you very much. Take it easy, and thank you very much to all of our viewers. Cheers.